Hi, I'm Yosefa, and in this video, you're gonna learn everything about candlesticks. Okay, not these ones, these ones. What do they mean and how do you read them? Well, watch till the end to learn about candlesticks and up your investment game. All right, let's begin. A candlestick chart shows an asset's opening, high, low, and closing prices throughout the course of time. A candlestick is made up of a candle body as well as an upper and lower wick. Now, the body is either green, meaning that the market is rising, or red, meaning that the market is falling. And in some charts, they appear to be black, representing a market fall, and white, representing a market rise. Each candlestick represents a particular time. So a 1 hour candle, for example, indicates 1 hour of trading data. Each candlestick body represents information such as open, close, low, and high. The open represents the initial deal of the period, while the close represents the last trade of the period. The maximum price reached throughout the period is shown at the tip of the upper part of the candle, and the bottom part of the candle begins at the lowest price throughout the time. And then the reverse is also true for a red candle. The market declined during the time, thus the open is the top of the body and the close refers to the bottom of the candle. Now, the wick is the line that extends from the top to the bottom of the body of a candlestick. And in some charts, they are referred to as shadows. Okay, so there's a bunch of different candles and I want to just touch on each of them for a little bit. So first up, there is the doji candlesticks. Doji candlesticks are distinguished by their tall wicks and small bodies. If a doji is spotted on a candlestick chart, this shows that the market has been volatile during that particular period. Doji is divided into 3 categories. First, we have dragonfly doji. A long lower wick on a dragonfly doji indicates a session-long bear run followed by a comeback to the starting price. Then the second one is gravestone doji. The huge top wick indicates that a higher price was rejected in favor of a lower price, indicating negative emotion. And then we have the long-legged doji, and it shows a state of market trend uncertainty. All right, next up then we have the hammer candlestick. So this candlestick is one of the most well-known candlesticks in the world of trading. It's used to spot resignation bottoms, which are usually followed by a price bounce, which traders take advantage of to establish long bets. Now, the shooting star should not be confused with the inverted hammer. While they both appear the same, their meanings are vastly different. At the peak of an uptrend, the shooting star is typically considered a bearish indicator, while at the bottom of a downtrend, the inverted hammer is typically considered a bullish signal. All right, let's move on to the next one, which is bullish or bearish engulfing patterns. A bullish engulfing candlestick is a big green candle that totally engulfs the previous red candle's range. This pattern typically appears during bearish trends. The bearish engulfing candlestick is made up of a bullish candle that is followed by a bearish candle that engulfs the first. And this pattern typically suggests that a bearish move is on the way and occurs during a bullish trend. All right, then we will move on to the morning and evening star pattern. So these 2 types of candlestick patterns are triple candle patterns. So during bearish periods, the morning star pattern appears and typically suggests an upside reversal. So this pattern begins with a bearish candle and then moves down to a little bearish or bullish candle. The price then gaps higher, forming a larger bullish candle. It indicates that the selling pressure from the first day may have subsided and that a bull market may be approaching. But the evening star pattern shows the opposite. It emerges during the positive periods and typically indicates a reversal to the negative. A bullish candle initiates the pattern, which is followed by a minor bearish or bullish candle. The price then falls down, forming a larger bearish candle. It typically denotes the conclusion of an uptrend and is incredibly significant when the third candlestick wipes out the gains of the first. All right, then lastly, we've got the bearish or bullish harami pattern. So a bullish harami candle is similar to a reverse form of the bearish engulfing candlestick pattern, in which the larger body candle comes first, followed by the smaller harami candle. The bearish harami candle is merely the inverted form of bullish harami. You can find the bullish harami candle at the end of a bearish trend, indicating that the bearish trend may be coming to an end. The bearish harami is quite the opposite. A bearish harami comes near the end of a bullish trend and signals the possibility of a reversal. In order to start understanding the market price and the charts, knowing and recognizing candlestick patterns can be incredibly helpful for you. Knowing what these patterns signify and what indications they provide can aid you in developing an investment strategy that you can use to your advantage. So, are there any other candlestick patterns that you think are worth noting? Are you ready to start reading candlestick charts? Well, leave us your thoughts in the comments below. We'd love to hear from you. If you'd like to stay updated to all things crypto, make sure you click the subscribe button and turn on the notifications. Also follow us on our socials for all the latest crypto updates. Bye.